So this is again Apple's income statement, um, sales, their expenses. Okay, this is cost of goods sold. This is operating expenses. Okay, so you can see here, this is their revenue. Revenues minus expense. This is their net income. What they're doing here is they're taking this net income and they're dividing by the number of shares outstanding. And they're giving you the share count here. Now, why these two, basic versus diluted? The diluted is assuming all the stock options that exist, all like the share, like there's certain types of transactions where there could be shares that are issued, like a stock option. It's assuming everything gets executed, and this is like the full share count of shares outstanding. Okay, so usually people will use the diluted, okay, to look at earnings per share. So they take this. This is like the total pizza pie, and they're dividing by this many shares outstanding, 15 billion, and that's giving you the earnings per share. Okay, so if a share of Apple stock is $200, what are you getting for that? You're getting $7.46 of earnings per share. Okay, so this earnings, even revenue per share, this is all useful information because in the end, you as a shareholder care about what you're paying and what you're getting for your one share of stock. Okay, so earnings per share is very useful as an investor. Um, yes, you care about overall how the business is doing, but when you're making an investment decision, you're doing a cost benefit. You know what you have to pay. This is what you're paying, or investing, you can say, investing. And this is what you're getting in the end, $7.46 worth of profit. So in order to do this cost benefit analysis, you need to know what the benefit is. And that's why earnings per share is presented right on the income statement because it's so important. Okay, this $200 per share, that's not on the income statement. Where would you get this price per share? Where is that located? Yeah, you'd have to go to Google Finance and look at this value of Apple stock. It's not going to be in the financial statements, right? Because that's a market determined price. Okay. You can think about it like this. The financial statements are always backwards looking. There have to be transactions that happen. Yes, there's estimates that are based on what's going to happen in the future, but really it's like a more backwards looking thing. The stock market is forward looking. It's projecting things into the future. Okay, so they're related because a good way to predict the future is to look at what's happened already. But really, the stock market is a forward-looking thing. You can see that it's growing over time, right? So, I mean, you could think of it as $200 divided by 7.46. This is the number of years it will take for you to earn your money back just to break even. But what people are thinking is that, well, this is not a static number. This is going to grow over time. Now, you can do the math. Now, you have Excel. You can figure out, well, if I grow this at 15% a year, how many years then? It will be obviously less than just dividing 200 by 7.46, but maybe instead of 20 years, it's going to be 16 years, and maybe you're like, that break even time is still too long, right? So yeah, so this is why I think a lot of people who are investing that aren't sophisticated, they don't understand valuation. This is all related to stock valuation. Yeah, of course. They can stop their stock buyback program, but they do that because they want, like, this share count you can see is going down, right? Every year, the share count has been declining because they're buying back stock, right? If they stop doing that, then the earnings per share is gonna start declining too, because they're basically reducing the number of slices every year. Really what they're trying to do is maintain this number because the $200 is based on this, how the stock is priced will be largely influenced by the earnings per share. The way that this was calculated, it's 112 billion in total net income was divided by the total number of shares to get this 7.46. The price to earnings ratio. So this is now, so The price per share was $260. 260 divided by the earnings per share is 34.9. So that's essentially the number of years at current earnings it would take for you to just recoup your money in earnings. Okay. So some might think that that's too high. Some people might be, well, like if I expect the earnings per share to grow and I'm going to hold it for a long time, and that when after 20 years, it's not like the value of the stock will be zero. I can also sell the shares for more than what I bought it for, right? So this is what stock valuation is all about. You have to use assumptions, use your judgment, use your understanding of Apple's business to project forward. It's not easy. It's a very difficult task to do. Yeah. Uh, so right now, the price to earnings ratio for Apple, at least at this time, was 35. Palantir in 2026, that same ratio is 200. Okay. So you could think about Palantir if at current earnings, it would take you 200 years to recoup your investment at today's prices. Okay. So, I would not recommend investing in Palantir because there's very few businesses that, first of all, can survive 200 years and maintain their profitability and grow it. Okay. So it's a very risky investment to make. I don't know the current investors who are buying at those prices. I don't know what they're thinking. I would love to hear their thoughts, but it doesn't usually make sense historically to buy something at such a high valuation. Okay. And then finally, we have return on common equity. Okay. So this is going to look at the balance sheet numbers and figure out how much net income is being returned on actual amount of investment that the shareholders have contributed, right? Because this is going to be based on how much money was actually contributed to the business. Because it could be that a business just sold stock in their IPO one time and never raised any more money. And it's purely financed through borrowing and through retained earnings. Okay. So the balance sheet is only going to have what the business is actually taken from investors. Okay. Through paid in capital, which is here. And in this case, it's an accumulated deficit. But this is what we call the book value. Book value. It's different than the market cap, as we talked about. But the book value, again, is related to how much capital is actually invested from investors. Okay, so it's good to know how much of that, like what is the actual return on that actual investment from investors. Again, the value of capital invested is the contributed capital and the retained earnings. Okay, and the return on equity is answering what percent return is the equity capital earning. Okay, um, so the formula is net income, which is kind of the total pool available minus any amount paid to the preferred shareholders. So that will give you how much the common shareholder is kind of entitled to. And then you divide that by average common shareholder equity, which is the book value of equity. So for Apple, we can see that our average common shareholder equity is basically this amount and this amount, the average, because this is beginning of year, this is end of year. So the average of the year is just this plus this divided by 2. So that's where we got this. The return on equity is equal to the net income, which was 112. That came from the income statement, divided by this, uh, basically this average equity, and it's 171%. So if you could buy Apple stock at its book value, which is 73 billion, then you would be making 171% return every year. So why do you think the business doesn't trade at book value? It trades at, the 73 billion, and I think it's in the trillions is the valuation. It trades at many multiples of book value in the market. It's because the value, the income generated is very high. So the stock price is going to be high. So the book value is not really um, related to the market value. The market value is going to be taking this and being like, well, how much would I pay to earn that much? Right? It's going to be whatever, $1 trillion. If I can earn $100 billion a year, I'm willing to pay maybe 10 times that for the business, so which is like a trillion, right? So the book value is not always useful, especially for tech companies that have a very low book value. But like insurance businesses, there are some businesses that trade very close to the book value. The market value and the book value are more aligned. Okay. Yeah. So here, 3.8 trillion divided by 70. So Apple trades for a 51x price to book value. Okay. And in that case, the return on equity is not very meaningful. But like, I just bought some stock today. It's an insurance company. They trade at like 1.2 times price to book. And their return on equity, if you use the book value, is around 20%. So I'm trying to buy this business at near book value. The stock dropped a lot today. Um, their earnings, they showed a loss. And if you guys want to understand more, I can tell you like more details. But the earnings, I read through the earnings call and I looked at the press release and they were actually good. There was a certain technical reason why they showed a loss, but the stock was down like 8 or 9% today. And I know this stock really well. So I was trying to buy because now instead of like 1.4 times book value, it's trading like 1.2 after today. So I'm like, this is a good deal. I wanted to buy more. Okay, so the reason I'm confident, I'm not scared that it dropped 10% is because I understand the business. I can read its financials, and I'm like very happy that it dropped actually. Because the performance of the underlying business was very good. It's just the stock is down for, technical reasons, trading headlines, as they say.